Student question: which of the following items best explains the accounting principles of reporting period and historical cost? The list of items we have are bank, creditors, debtors, GST clearing, loan, prepaid rent expense, prepaid advertising expense, and stock. Let's have a look at both of these principles separately to try and get an answer for this question. The reporting period principle says that the life of the business must be broken into periods of equal length of no longer than 12 months, but it's also got this second part which says at the end of each period the firm must calculate profit by matching its revenues and expenses. What does that mean? It means that the life of the business is broken into these little chunks or blocks called periods, and as each period goes we figure out revenues, we match those with expenses to get net profit. Another period goes by, we do the same. Another period goes by again, and so on into the future. The reporting period principle also says these periods can't be any greater than 12 months in length. They can be shorter, but no greater. So, looking at our question, which of these items best demonstrates that principle? We're going to go with these two prepaid expenses. It doesn't really matter which one. I'm going to use prepaid rent expense, but it could equally be prepaid advertising expense. To demonstrate, let's have an example. Let's say on the 1st of March, a business paid $15,000 for 3 months rent for March, April, and May. So there's two options on how to record that. The first option is we could record all $15,000 that's been paid as an expense for March. The second option is we could record the $15,000 as what's called a prepaid expense for those future periods of April and May. What would option 1 look like? That would be where we would record in March a $15,000 expense because that's when it's paid, and then we'd have 0 expense in April and 0 expense in May. So we've allocated our $15,000. So the impact then on profit when we go and match our revenues and expenses is the expenses, let's say revenues are $8,000. We'd have expenses of $15,000 in March, and we'd end up with a net loss of $7,000. Why this option is not correct is because in the second period we're not going to have any expenses. We've already allocated it to March, so in April expenses are 0, and also in May we have the same thing. So the problem here becomes that the net profit in the first period is too low, and then it gets subsequently in further periods it's going to be too high, and that's because we haven't allocated the expense correctly to the period in which it's consumed. So what is the correct option? Well, that's option 2. What we're going to do is record the $15,000 as a prepaid expense for April and May. What that does is it ends up putting $5,000 as an expense in March, then $5,000 in April, and $5,000 in May. Now the reason that's going to be most accurate is when we go and match our revenues with our expenses, we've got $5,000 in each period, and we get a more accurate net profit as a result. So option 2 is clearly correct. Let's go and figure out why it's correct with regard to the reporting period principle. So how does this work? At the start, when the $15,000 is paid for the future, we actually call that an asset, not an expense at all. So we would say we've got a $15,000 prepaid rent asset. That first month goes by and we use $5,000 of the rent that we've prepaid. That becomes an expense. What we've got now at the start of April is a $10,000 asset. The period or the month goes by, we use up another $5,000 as an expense, and into May we have an asset of $5,000. Lastly, we use up that and we end up with an expense of $5,000 for May, and eventually our asset just disappears. Let's figure out what that's got to do with the reporting period principle. There's our definition. Let's look at this part here. Reporting period principle says we must match or calculate profit by matching revenues and expenses. What's that got to do with this? Well, recording a prepaid rent expense allows the firm to allocate the monthly rent to the correct reporting period and therefore correctly calculate net profit by matching the monthly revenues with the monthly expenses. Let's look at our second principle, historical cost. It says all transactions are recorded at their original cost or purchase price and shown in the firm's accounting reports at their historical or original price. So if you were to buy a property for $600,000 and that's what it cost on the day you bought it, let's say it goes up over time to 630, maybe it goes down a year later to 580, and then it goes up to $700,000 in 2020. That's what happens in the real world. What this principle says, though, is that this property would always be recorded at $600,000 over time. It would never go up or down in value. It would always be recorded at its historical cost. So which of these items here best demonstrates that principle? We're going to use stock down here at the bottom. Let's have a look at an example. Let's say a shop buys iPhones to sell, so it could be a Telstra shop. They buy 1,000 units for $300 per unit, and on the day they buy them, that's its cost. The problem with that is over time, as the phones get older and a newer iPhone's released, the value of these phones goes down. So maybe after 6 months it goes down to $280, after a year it's $210, and after 18 months maybe it's half of what it used to be, it's $150. And that's just because you can't sell it anymore for a price above that, so the cost has gone down. Under the historical cost principle, though, the stock would always be valued at $300. It just wouldn't change. So, always valuing stock at its purchase price fulfills the historical cost principle by always recording the stock at its original or historical cost.